Good morning, everyone. My name is Suzanne Templin, and I coordinate the webinars for Houseman Johnson Insurance. I would like to welcome you to today. Let me start over. Sorry. I would like to welcome you to today's ACA and AHCA update presented by Pat Kelly. Today's webinar will run approximately 30 minutes, and after the webinar, we'll have a question and answer session. If you have a question during the webinar, feel free to type it into the question feature, and Pat will address it during the Q&A portion. After the webinar is over, there will be a short survey that we are hoping you can fill out for us. Also, please be aware that this webinar is being recorded and will be available for review on our webinar archives of our website. If you do not want to participate in a recorded webinar, you may want to close the application at this time. You will receive a follow-up email with a link to the recording from the GoToWebinar application. I would now like to introduce you to our presenter for today's webinar, Pat Kelly. Pat has been with Houseman Johnson Insurance since 2011 and has over 30 years of experience in employee benefits. He's passionate about building a relationship with clients beyond just being a product vendor. He forms client connections through honest communication, continuous education, and always doing what he says he will. Pat works with employers of all sizes and with both fully insured and self-funded medical clients, including defined contribution, HRA, HSA, and FSA. He also works with clients on their disability, life, dental, and vision needs. He has a wealth of knowledge on this topic, and we are very thankful that he could share some of his wisdom with us today. Welcome, Pat.
Thank you, Suzanne, and good morning, everybody out there that's listening. So today's webinar is just to try to point in on, how the American Health Care Act, if it gets passed in the measure that we know it today, how it's going to affect the Affordable Care Act and what's going, what we know of the Affordable Care Act today. And my God, what a bombshell with all the headlines today on the CBO announcements. I don't want to get too deep into that because they're just coming out, but obviously there's a lot of press that didn't look all that good for the AHCA today. But that said, kind of want to touch base first on where we're at with it, the American Health Care Act. Obviously, what happens next? We all know that the House passed this bill on a very slim margin. There are many GOP members that didn't vote for it. So it didn't, pass on a slim margin. If the House bill gets passed by the Senate with no changes, then the bill moves on to the President for signing. That would mean the Senate just looks at the bill and says, "We like this. We're gonna pass this." Then it moves right on to the President. If the Senate bill has changes from the House bill, it then goes to what they call conference committees. So there's conference committees made up between the House and the Senate, and then they work together. To work out the differences. If the conference committee reaches a compromise, it prepares a written conference report, which is submitted by, to each chamber, and then the conference report must be approved by both the House and the Senate, again, to move on to the President. Obviously, turn on the news, we hear a lot of things. If it doesn't get through the Senate, people are saying now it probably won't. This is all kind of a moot point. But that said, still kind of want to go over the bill as we know it today. So, the AHCA is what they call a budget reconciliation legislation. And why they call it that is because it can't be fully repealed unless we get 60 Senate votes to actually repeal a law. So many things we're going to talk about today are going to stay in there, but they can be changed because they're budgetary or they're tax, and that they can change without what they call a full 60 votes in the Senate to pass it. So that's kind of what's going on and why the changes they can make and so forth. Here's what the ACA provisions are not impacting. They're not impacting the provisions not being impacted are the requirements to cover pre-existing conditions. The bill as it's coming out today, and we'll talk about a waiver that states may get later that could impact, but as far as the AHCA, it's not changing the pre-existing condition requirements to be covered today. It's not changing coverage for adult children up to 26. That's going to stay as is. It's not going to change any prohibition on health status underwriting. So, there's still going to be that prohibition on health status underwriting. It's not going to change. It's not going to, the prohibition on lifetime or annual limits will not change. And that's both for individual and small group. You hear about the essential health benefits. That's really, small employers and individual plans have to comply with that. The guaranteed availability, renewability of coverage, cost sharing limits on essential health benefits for non-grandfathered plans won't change. And obviously the non-discrimination rules that have been passed will not be impacted. So I'm going to kind of focus on how it affects large employers, those who have to comply with mandates. I want to talk about small employers, all employers, and then I'm going to hit on how it affects individuals. But really for large employers, those who are applicable large employers, it basically changes the mandate. And it's going to change that retroactive back to January 1st, 2016. And really what I mean by that is basically it's going to take the penalties as we know them today, and the penalties for 2016, $2,260 per employee if you don't provide coverage, and $3,390 if you provide coverage but it doesn't meet minimum value or it's not affordable. What it's going to do to those penalties, it can't take the penalties away, but through the budget process, what they're going to do is they're going to make those penalties zero. So obviously, yes, technically the ACA penalties as we know them are still here, but they don't have a value. They're zero. So that's what this provision is going to do. For the most of this law, the way it was passed in the House, that's really one of the only changes to large employers is that penalty. So now for small employers, there are some changes. Insurers will be able to impose a 1-year 30% surcharge on consumers with a lapse in continuous coverage. Now, what they're doing on that is they're going to follow the HIPAA guidelines that we had before the ACA, and it's going to state if you have more than a 63-day gap in coverage in the preceding year that you're applying for coverage, then carriers are going to be allowed to put a 30% surcharge on consumers that have a lapse in coverage. Can't apply pre-existing conditions, but that 30% surcharge obviously is to keep, just like maybe, today we're going to talk about, I'll talk about a little bit later about the individual mandate, but that's kind of going to replace that and so forth. And it's going to allow, again, for small employers and individual plans, it's going to allow an increase in the premium age difference from 3-to-1 to 5-to-1. I'm in that 5 category, so maybe I don't like that, but it's obviously going to lower the premiums for the younger people to be able to hopefully more people buy into it and so forth. But yes, it could increase costs for obviously older people. And it's going to repeal the small employer tax credit, and that's going to go away in 2020. I don't think, we talk to our clients that are small employers, and we're very, very few employers that we work with that even qualify for that small employer tax credit. So I don't think that's probably not a huge impact on anybody. And as Suzanne mentioned, please, obviously, as questions might come up, please feel free to address those along the way and so forth, because we're moving along kind of quick here. Here's what the AHC provisions are going to, how they're going to impact all employers. The Cadillac tax is still part of the law because they, again, can't get rid of that, but they can delay it. and the Cadillac tax is now going to be delayed till 2026. Gosh, I've been doing webinars since 2012, and was it 2018 was the first date they were supposed to start? I don't even remember anymore. So that's next year. So now they're delayed until 2026. And then what also is going to be repealed is the limit placed on contributions to health flexible spending accounts. The limit right now is moving to 2,600. Obviously, it moved to 2,600 January 1st, or as of your renewal with your FSA. So we're going to go back to the old days. If you want to allow your employees to put away $5,000, $10,000, dollars in their flexible spending account, you'll be able to go back and allow that again. I kind of think a lot of employers are going to realize that maybe the limit that we even have today is probably justifiable for most people, but that's going to go away. They're going to repeal the annual health insurance provider tax retroactive to January 1st, 2017. Obviously, that's a tax that health insurers pay every year. So if that tax is repealed, hopefully we see that helping future renewals obviously, because that tax is no longer in there. The other part is Medicaid. I kind of put that in all employers. Medicaid is obviously we think of more of an individual piece, but Medicaid is really, by changing that, could affect employers. Now, I don't think it's going to have too much of an effect in Wisconsin because Wisconsin, our government here never moved on to the Medicaid enhancement. They kept the poverty line and being eligible for Medicaid at 100% of the poverty level. But a lot of states that you might have employees in, or you may have businesses in, have moved to the 138% of the federal poverty line. So that means if that changes and that line moves, obviously if it moves back closer to 1 in states, that's going to make a lot less people eligible for Medicaid. So obviously you have to make your plan design more attractive for those people who maybe have accepted Medicaid coverage versus the health plan because they qualified for it. And really what they're going to do is there's going to be federal funds will be granted to states based on a capped per capita basis starting in 220. And if states expand that, they can, but they might receive less federal support for additional persons being added in. So it's kind of going to hamstring states financially to increase their Medicaid program above the federal funds grants. So that's obviously, we're hearing a lot about that in the press too, about how it's going to affect possibly the Medicaid recipients and so forth. So how does the AHCA provisions impact individuals? Well, first, the thing that's going to go away, well, it's not going to go away. It's kind of like the employer mandate. There will be no individual mandate, and it's going to be effective retroactive back to January 1st, 2016, just like the employer mandate will be. And we're going to do the same thing with the individual mandate. They technically can't get rid of the mandate, obviously, unless they get a 60% Senate vote, but they can make that mandate zero. And that's what this law will do. It'll just be, yeah, you're being penalized, but your penalty is zero. What they're also going to do, and this is really kind of interesting here, is how it affects people is they're going to move to age-based tax credits to replace the subsidies and cost sharing reductions we know today that are based on one's income. So your income is not going to be the decision maker in your subsidies for your individual health insurance. What it's going to do, it's going to be based on the older you are, the higher your credit's going to be. That's kind of their way of offsetting, moving from a 3-to-1 age band category to a 5-to-1. And obviously, these tax credits will be phased out for higher incomes, and for singles and obviously families. And I didn't put the higher incomes in there because, again, what that is could change. So And this is really interesting how it's affecting people. You know, there's Kaiser has a great website, and if you ever go to the Kaiser website, they have a grid where they show every county in the whole country and how it affects individuals. And you know, it's going to affect individuals more in non-populated counties than it is in like Dane County. There's little effect. This law will have little effect if it gets passed in Madison, but it has a great effect in some of the outlying counties in Wisconsin, because more people in the outlying counties are qualifying for the current subsidies than they are here in Madison, Wisconsin, and so forth. So it's kind of interesting how it affects the nation as a whole. The other piece that's going to be repealed is the 3.8% tax on net invested income, again for high wage earners. Here's an effect that, you know, I climb on the fence post on. Yeah, if you have the money to be able to put into your HSA, great, but you know, if you don't, it looks like it's a benefit just for the wealthier, the higher wage earners. But basically, health savings account limits will be increased to a maximum out-of-pocket limit for your. It's going to be increased to your maximum out-of-pocket limit for your high deductible health plan coverage. Currently, for 2016, individuals that have individual high deductible health plan that qualifies for an HSA, they can put $3,400 max in their HSA, and families are $6,750. And what that's going to do is your max that you can put in your HSA is going to equal whatever your coverage out-of-pocket maximum is. Not the plan you have, but what the federal says, this is the maximum you can have. So actually, if this gets passed, those who are contributing to HSAs could contribute $6,550 if they have single coverage, and $13,100 if they have family coverage to their HSA for 2017. So obviously that gives people a lot greater chance to reduce their income and save for the future. And there's also HSAs will be allowed to be used for, you know, obviously certain over-the-counter medications that they can't be today. And there's a couple other things. The penalty if you use your HSA for funds that are not HSA qualified funds. Currently, the penalty is 20%. It's going to be rolled back to 10%, things like that. But I didn't think it was all that important to cover those and so forth. So that's how everybody is going to be impacted by the AHCA. Another impact that's going to go away is it's going to repeal the 0.9% Medicare tax, again on high-income individuals. So that's going to be going away as well. Here's kind of the piece that, you know, we hear a lot about because, you know, I'll be honest, there's many people talk about this, and I think very few know what they're talking about. I hope I'm not one of them, but the MacArthur Amendment was added at the end of the AHCA, and that's kind of how it got passed. So it just kind of gave certain faction in the House on the GOP side to say, you do this and we'll vote for the bill. And really what the MacArthur Amendment does, it gives states waivers to waive off out of certain requirements of the AHCA or the ACA, obviously. So if your state does not, if our state, Wisconsin, does not apply for a waiver, or a state that you have business in does not apply for a waiver, federal law is going to govern medical coverage in that state. But if states apply for waivers, and there's certain things they can do, as long as they show the reason why they're applying for the waiver is in the interest of lowering premiums and expanding the number of enrollees. Obviously, that's what they want to do. We'll see if it happens or not. So it would allow states to set their own definition of essential health benefits for individual and small group coverage starting in 2020. It will allow even a higher ratio of age rating above the 5.1%. So if a state felt they had to go 7-to-1, that state could do that if they're granted a waiver. It's going to waive community rating rules except for gender. So, as we know today, we have community rating rules. A lot of small employers don't really understand those yet because our states allowed a lot of our small employers to stay with their current coverage and not move into the community rating. But we have some groups that employers that have moved into community rating, and they kind of understand how that works. So it'll allow us to waive community rating rules for health status unless the state has set up, I guess it won't allow the waiving of community rating rules for health status unless the state has set up or is participating in a federal high-risk pool. That's kind of a big stumbling point out there for a lot of people because it's going to go back to, underwriting. People that don't show high risk will get the standard coverage, and then people obviously of higher risk will still get coverage, but it would be in a state or federal high-risk pool. Wisconsin used to have a HRSA plan. They had their high-risk pool. Most people thought it was a pretty good plan. Going back to one, who knows how these plans are going to look and how they're going to be set up and how they're going to be funded, obviously, to keep the costs, in line with other costs, so people with high risk can still afford their coverage. That's one of the big questions that everybody's getting today is how if states apply for waivers, what's going to happen in that state, with the insured and uninsured and so forth. Also, it's going to be granted. This is what states must show how the waiver will benefit their respective insurance market. They have to show it's going to reduce average premiums, that it's going to increase enrollment, that it will stabilize premiums for individuals with pre-existing conditions, and it has to show that by doing this, they'll be able to increase the choice of health plans. Obviously, get more carriers back involved in the market. Currently today, 1/3 of the counties in the United States, and there are some counties with no carriers in the marketplace, but many counties, 1/3 of them only have one carrier offering coverage currently in the marketplace. So the goal of this plan, remember, attaining that goal is one thing, but having a goal is, because having a goal is one thing, attaining it is another, would be hopefully to get more carriers back involved in the insurance game for people to choose from, which hopefully increases benefits and lowers costs, but that is to be seen. So that's really the MacArthur Amendment is what probably is creating the big storm out there, because people feel a lot of states are going to apply for that, probably be granted the waiver, and then what each state does, we'll just have to see so forth how that works. That said, I was 5 minutes short of our 30 minutes, and so hopefully there's some questions out there that I can address, and if I can't address it here, because remember, folks, this is a bill that's been passed. It's some stuff has come out on it, and a lot of things haven't been totally run through the ringer on it yet, so I might not have an answer. Let's see.
So the first question that we received is from Linda. She says, does this mean that for ALEs, there will be no penalty charged?
Good question. It just means the penalty will, if this law gets passed, the penalty will be 0. Large employers are still going to have to do the employer reporting. They're still going to have to do your measurement periods. You're still going to have to, if you're an employer that has variable hour employees, the measurement periods. So, but if it's deemed that you don't offer an affordable plan or your plan doesn't meet minimum value, that technically there's a penalty out there, but the penalty is going to be zero. So you won't be charged. You know, you'll get a penalty, but you won't be charged.
If there are any other questions, please continue to put them in the question space in the GoToWebinar app. I'm going to go ahead and pull up Pat's contact information. So if you find that as you're reviewing the information that he provided for us today, that you end up having some questions, please reach out to Pat via phone or email, and he would be more than happy to discuss those questions with you. It doesn't look like we're getting any more questions at this time, so I'm going to go ahead and let you guys go. Please do fill out that survey for us, and thank you very much for everybody attending today.
Yep, thank you. And like I said, again, if there's any questions, you want to give me a call or email, please feel free to do so. Thank you.